Sal.
Thank you.
Thank you, Masao. I'm pleased to be back in front of you to provide a financial overview for the Sony Music segment, which is comprised of the three categories that have been presented today: recorded music, music publishing, visual media, and platform, which are overseen by Doug Morris, Marty Bandier, and Masao Morita. As you have just heard about our incredible roster of artists, songwriters, our labels, and catalogs, our expansion into new areas as we continue to lead the industry forward. We believe that after more than a decade of contracting revenues, our industry, and the Sony Music segment in particular, has stabilized and is poised for steady revenues driven by continued creative success and growth in digital revenues, partially offset by the decline in physical sales. We expect to continue to grow profits and improve margins. During this session, I will review the historical performance of the music segment, our ongoing commitment to financial discipline and cost management, our strategy relating to strategic investments and acquisitions, and our future financial targets and guidance. As you can see from this slide, during the past 5 years, the sales of the music segment have declined from $5.5 billion in fiscal year ending March 2009 to $5.3 billion in the fiscal year ending March 2013. This represents a compound annual rate of decline of 1%. However, despite this decline in revenues, our operating income before income, depreciation, amortization, restructuring charges increased 4% compound annual growth rate. This was due to successful artist development, significant cost reductions, growth in our digital business, and growth in new businesses. With our profitability increasing in a period of declining revenues, our adjusted OIBDA margins have increased 200 basis points to 11.5% for the fiscal year ending March 2013. As was mentioned earlier, adjusted OIBDA is not a measure in accordance with US GAAP, and we will be providing a reconciliation of adjusted OIBDA to operating income in the presentation that will be available on the website. As mentioned throughout the presentation today, the music industry is starting to turn a corner, and the outlook is more optimistic than it was a few years ago. Against the backdrop of ubiquitous music, emerging digital models, and an explosion of interconnected devices and technology, the Sony Music segment is well positioned. For the first half of this fiscal year, the Sony Music segment generated $275 million of operating income before depreciation, amortization, and restructuring charges. This represents a 9% increase over the first half of last year, which resulted in an adjusted OIBDA margin of approximately 12%. Now let's take a quick look at the breakdown of revenues by category. In the fiscal year ending March 2004, the Sony Music segment was primarily reliant on the recorded music sales, which represented approximately 79% of revenues. Today, through organic growth strategy, investments in catalogs such as Famous, Lieber and Stoller, and expansions into new platforms such as the Artist Link, the animation in Japan, the Sony Music segment now generates almost 30% of its revenues from publishing and visual media and other platforms. And it's worth pointing out that the 12% of revenues that we now derive from music publishing does not include revenues from EMI publishing, as we account for this investment under the equity method. As illustrated on the next slide, while we have diversified our revenues in the segment, the shift within recorded music is particularly noteworthy. In the fiscal year ending March 2004, our recorded music business derived 93% of our revenues from physical sales. As a result of decreased physical sales, partially offset by the increase in consumption of music through digital downloads and music streaming services that Dennis talked about earlier, physical sales account for only half of recorded music revenues. We expect that over the next few years, digital revenues will soon become most of our recorded music sales. From this next slide, you can see that a portion of our revenues by geography has shifted away from the US and Europe to Japan and other parts of the world, including Latin America. While the US and Europe have experienced a loss in revenues over the last decade due to significant loss in physical sales, we have been able to successfully grow our business in Japan. This has been largely a result of the continued strong demand for physical product in the Japanese market, along with strategic investments in organic growth in businesses comprising the visual media and platforms category. In addition, as Edgar mentioned, we continue to be focused on growing our business internationally, including other parts of Asia and Latin America. We have been successful in establishing local repertoire as well as exploiting content from US and other countries. Our ongoing commitment to financial discipline and cost management is evidenced by the transformation of the business that has taken place and how we are positioned today. Early on, we recognized the fundamental shift that was occurring in the music industry and aggressively realigned our recorded music business in response. As I previously highlighted, our cost reduction initiatives on the recorded music front, which covered everything from real estate rationalizations to process improvements, have resulted in approximately $700 million in gross savings and a headcount reduction of 4,500. In addition, as we've shifted advertising dollars to the more efficient channels, we have been able to reduce global marketing spend by $300 million while driving improved reach, impressions, and impact. Furthermore, as we continue to shift from physical to digital formats, we have reduced our global supply chain costs by 5%. And despite all these improvements to date, we continue to look for cost reduction opportunities to further drive down our SG&A going forward. While on the recorded music business has required significant rationalization to address the challenging dynamics, our team at Sony ATV is incredibly focused and disciplined on a right-sized cost structure. When we looked at EMI Publishing last year, we knew that this investment only made sense if we fully integrated EMI's operations, significantly reduced the cost structure, and met aggressive return hurdles. As Marty indicated earlier, everything is fully on track to integrate EMI by this coming June, and we expect to reduce EMI's pre-overhead costs by 66%. While our realignment of the recorded music and integration of EMI are just two examples of proactive cost management, we are constantly on the lookout for further efficiencies that we can drive through the business, as well as take steps to align ourselves with future trends. Also, as more and more of our revenues come from digital channels, we'll see natural improvements in margins as a result of certain physical costs being eliminated or reduced. We are not only focused on driving efficiencies in our business, but also investing in the future. Whether we are investing in partnerships such as Psycho to tap into Simon Cowell's exceptional artist and repertoire skills, or in catalogs such as EMI Music Publishing to gain some access to the most sought-after songs of all time, or in digital platforms such as Vivo, we are focused on disciplined capital deployment with high return hurdles. Our ability to deploy Sony Music's cash flow to generate healthy long-term returns has earned us the continued support of Sony Corporation. So what does this all mean? Throughout this presentation, I have indicated that the Sony Music segment is well-positioned for continued growth and profitability. For the fiscal year ending March 2014, we expect to increase significantly, revenues to increase significantly, and operating income to increase on a year-on-year basis in yen, driven by positive operating performance and currency impacts. Looking forward to fiscal year ending March 2015, we expect the following based on a 1 to 100 dollar to yen exchange rate. Revenue of $4.8 billion, operating income before depreciation, amortization, and restructuring charges of $625 million, giving us an adjusted OIBDA margin of 13% compared to the 11.5% for the fiscal year ending March 2013. Operating income of approximately $450 million, giving us an operating income margin of 9.5%. Taking a longer-term view, we expect the Sony Music segment's annual growth rates from fiscal year ending March 2013 to fiscal year ending March 2017 to be as follows, based upon a constant 1 to $83 to yen exchange rate. Total segment revenue growth rate to be flat to slightly up. Recorded music revenue growth rate to be essentially flat, with the continued decline in physical offset by increasing digital growth. Music publishing revenue growth rate in the low single digits through continued exploitation of the world's leading catalog and iconic songs. Visual media and platform revenue growth rate to be flat to slightly up, with our new businesses such as Zepp providing modest growth to our mature, stable businesses which generate the majority of sales for this category. Segment operating income before depreciation, amortization, and restructuring charges growth rate to be in the mid-single digits, and the segment's operating income growth rate in the mid to high single digits driven by cost efficiencies. Based upon a slight increase in revenues and a continued growth in operating income, we expect continued improvement in our operating margins. In closing, to echo the comments made throughout the music segment presentations, this is an exciting time of change and opportunity for the music industry. As we think about the future, we believe we have the best assets, the best top management team in the industry, and the best strategies to be successful and deliver continued growth and profitability. Thank you.